Is the Brisbane property market cooked? That's the question a lot of investors should be asking right now. Because Brisbane has had an incredible run. Prices have surged, rental yields have tightened, and a lot of people are assuming the Olympics will keep pushing values higher. But I don't want to look at this just through the headlines, hype, or opinion. I want to look at this through data. So in this video, I'm going to break down Brisbane using price growth, rental yields, supply and demand, population growth, and infrastructure investment to work out whether the market is overgrown, overvalued, or whether there are still pockets of opportunity hiding in plain sight. So let's start with the most obvious lagging indicator in any property market, price growth. Because if you just look at the numbers, Brisbane has had an extraordinary run. Back in January 2019, the median house price in Brisbane was around $535,000. Fast forward to January 2026, and that number has climbed to roughly $1.035 million. That's almost doubling in value over 7 years, which works out to be roughly 13% in annual capital growth. And over the last 12 months to February 2026, Brisbane property values have increased 17.3%. Now that is an incredible performance by any standard. But price growth alone doesn't tell you whether a market is healthy, because prices can grow too quickly, and when they do, they often start to detach from fundamentals. Which brings us to the next metric, rental yields. Rental yields tell us something very important. They tell us whether income growth is keeping up with price growth. And in Brisbane right now, that relationship is starting to look a little stretched. Across the city, the average rental yield sits at about 3.3%. That's actually slightly lower than the combined capital's average of 3.4%. But when we dig a little deeper, something even more interesting appears. Across Brisbane, there are only 5 suburbs with rental yields above 4%. Just 5. 4 of those suburbs are located in Brisbane East, and the 5th is South Brisbane in the inner city. Those yields range from roughly 4.6% to 5.3%, which is reasonably strong. But the bigger takeaway here is this: capital growth has been significantly outpacing rental growth. And when that happens, yields compress. That doesn't necessarily mean the market is about to fall, but it does suggest that prices may have run ahead of the income supporting them. Now let's zoom in on what's happening right now, because the short-term trend can tell us a lot about where the market might be heading next. Over the last month, Brisbane dwelling values increased by 1.6%. Over the last quarter, values have increased 4.8%, and overall, Brisbane dwelling values are currently sitting at record highs. But when we look at this trend more closely, something interesting appears. While annual growth remains strong, the short-term quarterly growth trend has started to slow slightly over the last 4 months. This doesn't necessarily mean the market is about to turn, but it does suggest the rate of acceleration may be easing. Another interesting pattern appears when we break the market into value segments. Over the last quarter, the top 25% of property values have increased 3.4%. The middle 50% of market has increased 5.5%, and the lowest 25% of values have increased 6.4%. In other words, the lower end of the market is growing faster than the top end of the market. And this is actually a very common pattern when affordability starts to tighten. When borrowing capacity becomes stretched, buyers move down the price spectrum. They start looking for better value options, which pushes growth into more affordable segments of the market. Now let's look at supply and demand, because this is one of the most powerful drivers of property markets. At the moment, Brisbane has 10% fewer new listings compared to last year, and the total number of listings are down 21.9% compared to this time last year. Lower supply tends to support price growth, but there are some subtle shifts happening here as well. For example, the average number of days on market has increased. Over the last 12 months, it has moved from roughly 19 days to around 28 days. Now, that doesn't mean demand has disappeared. In fact, demand is still extremely strong. Across Greater Brisbane, there are around 220,000 active buyers in the market. So while listings are low, demand remains high. And that combination is one of the reasons why prices have continued rising. The rental market is also extremely tight. Over the last 12 months to February 2026, rents have increased 6.4%, and that's higher than the combined capital's average of 5.3%. Vacancy rates are sitting at around 1%, and that is considered a very tight rental market. When vacancy rates are this low, tenants compete for available properties, which pushes rents higher over time. So while yields have compressed because of strong price growth, rental demand itself remains very strong. Another major driver of the Brisbane market is population growth. Queensland currently has a population of around 5.8 million people. And according to the National Forecasting Program, the state is expected to grow at roughly 1.49% annually over the next 15 years to 2041. That's one of the fastest population growth rates in the country. Population growth drives housing demand. More people means more households, means more renters and more buyers, which is one of the key structural forces supporting the Brisbane market. And then we come to another major factor: infrastructure investment, because Brisbane is currently seeing billions of dollars being invested into major projects. Some of the largest include the Brisbane Airport Terminal upgrade at up to $6 billion in investment, the Centenary Bridge upgrade around $250 million, the Cross River Rail Albert Street precinct around $1 billion, the Lytton Refinery expansion at around $1 billion, the Gabba Hart precinct development at around $3 billion. And lastly, the North Newstead development, another $3 billion project. Infrastructure like this typically creates employment, economic activity, population growth, and over time that tends to support property markets. But there's another factor that could have a significant impact on the Brisbane property market over the next year or two, and that's interest rates. Because while supply and demand help drive markets, borrowing capacity ultimately determines how much buyers can actually afford to pay. And right now, the big four banks are forecasting that interest rates may rise slightly further before eventually stabilizing. According to recent forecasts from major banks, ANZ, CBA and NAB are currently predicting a 25 basis point increase in May, which would bring the RBA cash rate to around 4.35%. Westpac is slightly more hawkish, forecasting 3 increases, one in May, followed by additional rate rises in June and August, which would take the cash rate to around 4.85%. Now, why does this matter for property markets like Brisbane? Because interest rates directly influence borrowing capacity. When rates rise, buyers can borrow less. And when borrowing capacity tightens, it usually slows down price growth. So if interest rates do move slightly higher this year, it could create a short-term headwind for property markets. However, the important thing to remember is that markets tend to adjust over time. Buyers adapt, incomes rise, and populations continue to grow. And eventually, borrowing capacity stabilizes, which means the impact of interest rates is usually felt more in the short term than the long term. And that's why understanding both macro environment and local fundamentals is so important when analyzing property markets. So when we bring all of this data together, what does it actually tell us about the Brisbane property market? Firstly, there's no question that Brisbane has experienced very strong price growth. Prices have almost doubled since 2019, and over the last 12 months alone, the market has delivered over 17% capital growth. At the same time, rental yields have compressed, which tells us that prices have been rising faster than rents. In the short term, we're also seeing some early signs that the pace of growth may be starting to moderate slightly, with quarterly growth trending downwards and days on market increasing. On top of that, the outlook for interest rates suggests that borrowing capacities could remain somewhat constrained in the near term if the Reserve Bank continues tightening policy. But that's only one side of the story, because when we look at the broader fundamentals supporting Brisbane, they actually remain very strong. Population growth is among the fastest in the country, vacancy rates are extremely low, and demand for housing remains high. Billions of dollars of infrastructure are continuing to reshape the city, which means that the Brisbane market is likely becoming more selective rather than simply overheated. Some parts of the market may already be fully priced. Others may still offer long-term opportunity, particularly where strong fundamentals continue to support demand. And that's why investors need to move beyond headlines and hype and start looking at the data underneath the market. If you'd like help analyzing property opportunities using a data-driven approach, you can book in an initial strategy session using the link below. And if you found this breakdown useful, make sure you subscribe to the channel, because here we focus on data, strategy, and long-term property investing principles, rather than just chasing short-term headlines. Thanks very much for watching. See you in the next video.